There are two more tax deadlines this month for self-employed individuals and for businesses whose fiscal year ends at the end of December. Our guest is Nicole Ewing, Tax and Estate Planning Director at TD Wealth, and she has some tips for those of us who have to file. Nicole, thanks very much indeed for joining us.
Oh, my pleasure. Thanks for having me.
Start off with the self-employed. What do they need to bear in mind?
Well, certainly the best way to reduce the tax is to make sure that you're claiming all of the deductions and credits that you're entitled to at this time. So a laundry list of expenses that you could potentially be using. Most of those are going to be familiar to people. So we have advertising costs, motor vehicle, pens and papers, and the things that you use in your office. But something that's often missed is the fees, penalties, bonus payments that you might need to pay in order to change your financing arrangements and take advantage of perhaps a lower interest rate that might be available to you. So if you have had the opportunity to reduce the interest rate on a loan that is used for your business, you are able to use use that as to claim that amount against your taxes as an expense. Now, there's some limits around that in terms of how much time you have to do that, but a very useful way of doing reducing your overall income, as well expenses that you may have used to actually secure the loan. So application fees, appraisals, processing fees, legal fees, all used to secure that financing can also be claimed as an expense against your income. Again, some rules around. There's a 5-year window that needs to be kept in mind, but software, your accountant can advise you on that, but making sure that's top of mind. And another one, if we have a bad debt, so if there is somebody who you're really hoping would be paying you for the services that have already been rendered, products that have already been received, if you have an account receivable and you simply know that this money is not going to be coming to you, might be time to think about that bad debt and actually claim that on your taxes as an expense and to have that deducted against your income. If the money's not coming in, you may as well not be paying tax on it.
That's interesting. So fees to get a loan and also fees for early paying back of credit you got from a bank or another institution. What about bad debts? What's the basic rule there if you're self-employed and a customer stiffs you?
So you must already know that you must have already been treating it as an account receivable, have already been claiming it as an account receivable, and you have to regard it in that year as a bad debt, that you're not going to have that income coming to you. So it's not something that should be done lightly, because of course, once that debt is claimed, it's not, and that income is received, that's going to be another issue altogether. But a bad debt, better to cut your losses on that. If the money's not coming in, we don't want to be paying the taxes.
Remind us of any changes in tax laws or regulations that people need to worry, independent business people, self-employed. For one thing, these new rules about the capital gains, are they already in place de facto?
Well, they're not in place yet, but essentially we need to be acting now if we are going to be doing anything in advance of the June 25th deadline. So if you are operating your business, for example, through a corporation, you would want to be looking well in advance, Tuesday, of the deadline to be able to do any of that planning. So I would caution to be doing that mindfully. So we've heard a number of people who are concerned about the increase in that capital gains rate coming. And so they're doing some planning to pull some capital gains out to realize them early. But you need to be mindful about the potential impact on your small business rate, for example, for next year. So if you realize significant income within your corporation, you may have too much passive income to be able to utilize that small business deduction that gives you that preferential rate for small businesses. You would also want to be careful about how you are pulling out any capital dividends that might be accruing. If you have a balance in your capital dividend account, the math really needs to be crunched here to make sure that you're not offside. And if you do have a balance within your CDA account, you might be wanting to pull that out now. But again, get your advice. And if you are realizing more income now. As an individual, for example, you're realizing some of those capital gains. That might then impact your installment requirements for next year. So the amounts that you would need to be paying in installments to the CRA, you would need to have the liquidity in order to pay those taxes. So we have those rules are coming in on the 25th of June. Essentially, we need to factor in the amount of time to settle any of those trades. For example, if you're selling securities, to make sure that paperwork is signed by the deadline. And that's not the 25th, right? That's early next week.
Right. Okay. So I want to, sorry, give me that thing about the deadline again. Are we talking about, and the capital gains, I'm sorry to harp on this, but it's as though the rules will actually be in place as of June 25th. Is that it?
Yes, correct. So even though we don't necessarily have legislation at this point, we have seen the Notice of Ways and Means and it's gone past first reading. We must assume that legislation is going to come into place on June 25th. Okay. And once that comes into place, individuals now on $250,000 of gains, capital gains that they receive, will have the 50% inclusion rate. Any amount over that will be subject to a new 2/3 inclusion rate. And for corporations and trusts, the first dollar of income is going to be subject to that new 2/3 inclusion rate. That's going to be effective as of June 25th. So if any planning is to be done, it must be done in advance of the 24th. There's a couple of exemption on trusts, graduated rate estates and qualified disability trusts, but those aren't necessarily going to be relevant to the business owners that we're chatting with.